Okay, so number 3. Yes, ladies and gentlemen, number 3. Okay, and I believe you can zoom in your video, right? I hope. Company X is expected to pay out or pay at, I'm looking through a very, what's the word for it? If I can move it over here just a little bit. Did I cheat? Yes, I cheated. But, you know, it's nice to be able to write down a solution, but knowing how to solve it is a whole different thing. Company X, dividend discount model, that's our basic model that we're working with to solve and value stocks so that we can figure out whether they're under or overvalued compared to the market price. Company X is expected to pay an end of the year. Here I am looking at the camera, and I should be looking at the text. Pay an end of the year, dividend of $5 a share. After the dividends, its stock is expected to sell at $110. That's P1. If the market capitalization rate is $8, otherwise known as the opportunity cost of capital, or depending on how it's used, the discount rate, right? Because basically we do take this model and it is the most basic form of the dividend discount model, just shy of being what I would call the Gordon growth model, which is used for constant growth in dividends and dividend streams. Anyway, if the market cap rate is 8%, what is the current stock price? I'm going to show you a few tricks on the calculator as well that I think would be incredibly helpful. In this chapter, Excel definitely lends itself to assisting you or any other spreadsheet program. So with that said, let's get to it, and then I'll come back to just a brief review of the chapter, and I'll be reviewing it as we go through these problems. So number 3, there's the problem right there. I'm going to place this over there and try not to. You guys should see this setup that I have. My gosh, talking 2 cardboard boxes and 2 rulers. Okay, let's look at number 3, and I'm going to zoom out and hoping you can zoom in. I'll be double checking the video to make sure you can do that. When I look at this, and I'm going to sit down here for a minute. When I look at this, basically it's saying, okay, company X, what's its value or current stock price, what it should be, right? So let me grab a blank piece of paper here. What, in this case, right? What is our formula? Our formula is the most basic of the dividend discount models. It is next period's dividend plus the expected price at the end of, let's say, the investor's holding of the stock when they get rid of the investment, over, or you could say the forecasted or expected sales price, okay, at some point in the future. Discounted by 1 plus the market capitalization rate or opportunity cost of capital or discount rate, right? Just depends on how you're using this in its context. And this would be to the 1, okay? And so in replacing this, and let's see, we've got, and you could actually use the calculator in doing this, but when it comes down to it, and I will show you that this, and let me solve this. So I will go through and solve these problems real quick. Then we'll come back and just take a quick peek at the chapter, okay? So, and I think it'll lend itself to the chapter as well. So in essence, when we do this, don't forget that we're going to end up with something very similar to what I have right here, and I'm trying to make sure that you can see that. You can see it. Yes, you can. Okay, and let me blow it up there. And I didn't expect to have such messy notes, But we have $5 per share plus 110. So this is the dividend of the next period, right? This actually comes from the concept of perpetuities because it's dividend over R. But in this case, we're talking about the dividend of the next period. We're always talking about dt plus 1, okay, or d1. Sometimes we get d0, we're given d0, and then we have to figure out what the next dividend is given the growth rate. So it's $5 plus 110 for P1. This is D1, 1 plus R, which is 0.08, okay, pretty straight up formula. And we get for a present value of this particular stock of company X for number 3. This is number 3, okay, which is $106.48 rounded, okay, or 0.48148. And, you know, if you think about this, this particular problem is, especially this formula right here, our most basic dividend discount model, represents the market in equilibrium, okay? So that's a nice part about it, and represents, in this case, it represents, along with, I would say, the Gordon growth model, it represents stocks of similar risk, okay? So in this case, the nice thing that we can do is we can see whether, you know, let's go back and see what we get. So we've got $106.48 per share, okay? And let's say if it was currently trading at $90 on the market, okay, is it under or overvalued? Well, in equilibrium, or its intrinsic value, so to speak, not intrinsic, implicit, it should be given its risk level. And remember, what's the risk measure for stock? It's beta, right, or systematic risk. So when we look at this, we're looking at $106.48, yet it's down here trading at $90. Okay, so it's actually, the market is undervaluing it at this point. So would it be time to buy? Might not be a bad idea, because it's actually supposed to be worth much more, right? So that's kind of how we look at it. So, and again, this model, this one right here, okay, is the dividend discount model. It's the beginning of it. And when we look at it, this is really the representing the value of stock in a nice competitive market where everything's working just fine. Stocks are basically of the same risk levels, okay? And that's the cool thing about it. So you can actually, they're priced in terms of not only their price, but their returns and of stocks with similar risk levels. And again, this is in equilibrium. So we can use this as a tool to be able to see whether stock's under or overvalued. Okay. And before I go into the next few problems, which I am going to use my calculator. And by the way, could we use the calculator on this one? Most definitely. Okay. But it lends itself, this calculator right there. All right. We could do this just by plugging away at it, entering. It's easier to enter, instead of using these, to enter these, okay, and just enter it manually. So in other words, enter it $5 plus 110 divided by 1.08 to the 1 will give you, and that's how I got this number. Okay, it's much easier to do that. All right, next topic. Okay, and then I'm going to come back and review these models in very quick, short synchronicity. Okay, actually, let me just take 5 minutes and review this right now, and then I will come back to number, 18 and number 20, and then there's number, don't worry about number 23. but definitely make sure you cover the model of net present value of growth opportunity and the example of Stuart Living discussed in Sam Schuzet's, I believe it's video part 3 that I'm posting. Okay, be aware of that model, know how to use it. It's a very nice, simple example of using the current asset level plus any future growth opportunities to value a stock, especially when you don't have dividends. So, you guys, so if you don't want to review the chapter, turn it off right now. Come back in 5 minutes, okay? As I do review the chapter, when I do, and I've already said this, when I post Sam Schuzet's, Professor Sam Schuzet's videos, he will be pretty much covering just slide by slide. Even though he doesn't post or use slides, he's going to be using the same concepts, examples in our PowerPoint and in our text for chapter, chapter 4, right? So the value of common stock. You guys, in terms of how stocks are traded, I think we've covered this again. How stocks are valued, the basic formula. This, I just wanted to show you this. This, of course, is also mentioned in Sam Schuzet's video. The whole idea behind, and this is the little mini review I was telling you about. The whole idea behind this is that we are able to discount future cash flows, and then sum them up. Okay. And that's what we do with any cash flow. It doesn't matter whether we're talking, coupons, dividends, free cash flow, etc. And that's basically the gist of it. But when we move from a basic dividend discount model, which now this is a very, very simple form of that, but there's many more applications that we can use this valuation of common stocks via the dividend discount model, such as, looking at dividend growth. And in this case, we do use a model very similar to that. So the way that this works, and I'm hoping that you can see that, okay, I'm going to show you a picture of how I have this set up so you guys can have a good laugh. Okay, so again, this is in equilibrium, all right? This is our basic dividend discount model, right? And don't forget that it can be separated into two components. And it's basically made into expansion. It's made for expansion because we have multiple applications of, let's say, non-constant dividend growth, constant dividend growth, zero dividend growth, and multi-stage dividend growth. So up to 3 or 4 stages. We won't get into that. But before we get there, I just wanted to show you that basically the theory behind it is that, again, when you have these dividends, and if you're given some growth rate or you're not, you place the future expected dividends out there. So again, how are we valuing the stock? We're valuing it based on expectations or forecasts of the quote-unquote expected future forecasted dividends, okay? And then we discount them, and then we sum them, okay, to get our present value. And this can be summed up. The only thing a little different here, and this is, after this is, I'm going to introduce the Gordon model, is in the end, as we keep going out, right, this one right here is called the terminal value. Okay, it's that price that we sell the investment for, expected or forecasted out in the future. That'll be the end of our investment right there. This is actually called the terminal value or the horizon value. We can continue on. Okay, let me take a water break here just for a quick second. One second. By the way, I'm also going to be posting a few videos, one on spot rates, the other on duration. Nothing difficult, okay? I I've taught this class for quite a few years now. I have a sense of what's going to be really difficult, and I know that it's a good idea to make the test short. Okay? So with that said, just realize that what the farther we go out with our terminal or our horizon value, right, of the stock price at some future point, this stock price actually represents, and now let me go to the Gordon growth model, basically a perpetuity. This is, in essence, we can take this out to infinity, right? And as we go farther out into infinity, the present value of the horizon value of the stock price goes to zero. So what we can do is basically sum it up in simple form, just like this. So you've got, you basically have, and let me close ranks here a little bit. You've got dividend T, okay, over 1 plus R to the T. And this is plus the horizon value of stock P. And that's the selling price, okay? But you're going to find out that the horizon value is actually signifies something different. It signifies future, basically future dividends. So a good example of this, and I think to show you is to use an example. But I do want you to at least make you aware that, going from this to then going from, instead of dividend 1, then we can use dividend 2 and keep on expanding it. So let me give you an example. I think that's the best way to do it. Again, this is used for multiple applications. Please remember that one, okay? And the farther we go out, the closer the present value gets to zero. So when we're discounting all these back and summing them up, it's also a good idea to understand a little bit from chapter 2 and draw from that. And that's where the Gordon growth model comes in, okay? So again, the whole gist of this is really, the present value of a stock price, or the value of a common stock price, is just looking at all the future expected dividends, okay, going out. All right, and then we do take, once the dividends start to settle into a regular growth rate, then we will take, that's when we take the horizon value. So that actually is the key. And the Gordon growth model, if I flip it over here, the Gordon growth model, which does, again, like I just said, probably 3 times now, I'm repeating myself, allows us to take the present value of the stock based on all future dividends and taking the present value of that. So if you look back to chapter 2, when we were dealing with perpetuities, and we had a simple growing perpetuity, right? In that case, we had, and let me stand up here. I think it's easier to stand up, make sure that you guys can see this. We had the dividend or cash flow back in chapter 2, the cash flow of the next period. In this case, we're having a dividend of the next period. And this is actually a model that allows us to value, okay, a stock, P0, at time 0, take the present value of it. And it's really looking at a instance, and again, this is a different application of dividend discount model, where we are using basically a constant growth rate, okay? So from a certain point on, including it could be time 1, dividends will grow out for a constant rate, okay? We use the other models based off of this one right here to build into larger and longer non-constant into constant growth rates, etc. And that's when we use our horizon value right there, okay? Because the horizon value, and I think the horizon value is pretty well explained once we get to a problem, okay? But the horizon value is just representative of, let's say, you get out to year 6 and then all of a sudden the growth rate starts to slow up into a steady rate, let's say 6%, 5%, and it will pay dividends for as much as we know for the rest of its life at that rate of 5%. So that can represent a perpetuity. In fact, a perpetuity at constant growth. So that's why we use this, okay? And this is called actually the Gordon Growth Model by Ira Gordon, 1960, who published it with Professor Shapiro. And you can also, moving into the market capitalization rate, you can also flip this around and take the variation of it and get the market capitalization rate. And this right here, the dividend next period over R, would represent your dividend yield, okay? And this right here, G, okay, just like that other formula we used, right, would represent the growth rate or capital gains, okay? Especially when you look back, you can see the price appreciation, P1 minus P0 over P0, okay? So with that said, and again, we use these models to be able to tackle things like valuing a business, buying startups, and all types of valuing small businesses. Cash flows come in really handy. And when I talk about free cash flow, I'm really talking about cash flow from assets. And those cash flows that are derived from the operations and using our assets, okay? So with that said, I think that pretty much covers it, except for just the last couple of notes. And I'll mark off this area on the video so that you guys know that I'm covering this area right here. Lastly, if no dividends, we can use earnings, right? And that is the link between, as they say in the stock, in the PowerPoint, the link between the stock price and the earnings per share. And that allows us, again, just like dividends, we put the earnings as the cash flow that goes out into a stream, okay? Now, we can also use it along with the concept of net present value of future growth opportunities. And lastly, I'm looking at this. I think another important one to know, and then I'll follow up with the Gordon Growth Model, just a couple points, and that's it. Then I'm out. Where do we get G? G is, in fact, I might even put this review at the end because I think it's more valuable to see examples. G, in this case, okay, is the dividend growth rate, obviously. Okay, ROE, earnings per share, over the book value of equity per share. And that's what book value is. It's just the book value that comes from the balance sheet of the equity on a per share basis. Okay, you guys, where are some sources that we can get or draw upon for our growth rates? Because there's also earnings growth rates, right? And in this case, we can look back to recent historical growth of dividends. We can look at, because I've had several people ask me this question in other classes. We can look at analysts' estimate of growth in earnings. And we can also get it from the sustainable growth rate for companies, okay? Sustainable growth rate leads us to how we get this ratio right here, okay? Sustainable growth rate is just basically the rate that how fast a company can change given that they're using their debt, not their equity, for financing, and maintaining their debt to equity ratio is constant, okay? This is actually how we arrive at G, okay? And it's very valuable to know. This is return on equity times the plowback ratio, okay? Plowback being retention. So if we're not applying back a certain amount, reinvesting it back into the business, again, and that becomes what we would call retained earnings, right? And the opposite of plowback or retention is the payout ratio, the dividend payout ratio. Okay. So again, these are sources. Looking back, this is a good a good item and equation to know for the growth rate. Lastly, as I talked about, Gordon growth model from Myron and Gordon, 1960, and they continued on to do some work along with Dr. Shapiro. And one of the key factors with this model that we talk about, and here's the model right there, okay, is that the dividend in the next period over R minus G, you want to make sure that R is greater than G or the model falls apart. It really works well, especially when you're pricing other stocks. It works excellent because you're working with the risk factor. So in other words, you want to look at stocks that are not unlike. How can I say this? Unlike, for lack of better words, unlike the initial dividend discount model we used, the Gordon growth model is really popular because you can use basically stocks within the same risk class that have the same beta level. Or systematic risk, okay? Not systemic risk, but systematic, which I often confuse. By the way, this is the formula for sustainable growth rate, or ratio, excuse me. And the Gordon growth model works really well in valuing stocks. So you're going to be able to evaluate and say whether it's undervalued or overvalued, using the model to get its implicit value. And you want to apply it within a company that's got strong and stable earnings, a firm with high dividend payout, because management tends to want to keep those dividends going out, okay? As shareholders enjoy those, and they are very popular. And if management doesn't have a dividend payout policy, then they'll tend not to have one, right? But if they've had one in the past, they usually continue payout. And you want to be working with a firm, especially if you're applying this Gordon growth model, that has stable leverage, okay? So again, if XYZ is using, let's say XYZ is a stock, and they're implicitly priced at $20, and it currently trades on the market, they're implicitly priced at $20 using the Gordon growth model, and they trade on the market at 10, okay, that's going to be, it's going to be showing that the model, at least, is showing that the market is undervaluing it, okay? And so you will see a lot of people basically wanting to buy into that position and go purchase it. So anyway, we will get back to the problems now. Ding, 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 ding. Hey guys, now I'm going to get into, again, we went through number 3, which in essence used the most basic dividend discount model, showing the market and competitive environment equilibrium, where most stocks are priced accordingly. In this case, when we talk about risk, we're talking about beta. And as it gets towards night, I can't talk. I noticed that. Don't make fun of me. No, I'm teasing. Okay, so if the price is basically, above the security market line or equilibrium, especially when we're looking at return versus beta, and beta being systematic risk of the stock, in comparison to the market beta, by the way, then as the price goes up, especially when a price is above the equilibrium, the price is going to go up, the expected return is going to go down. I just wanted to reiterify that definition and relation. So with that, we did go through number 3. Okay, we found $106.48 per share. And let's go on into number 18. Okay, and I will zoom out and zoom back in here. All right, so number 18, I believe we are looking at, and let me move my camera, my phone video over. All right, down to there, right there. All right, so stock A is expected to provide a dividend. So you've got 3 stocks, right? And basically what you're going to do is you're going to take the market cap rate and discount each one of them, or get the valuation of each one of them using a different type of model, or form of the same model, basic dividend discount model. So when we do that, and by the way, this is also called discounted cash flow model for valuing stocks. When we look at this, stock A is expected to provide, this is A, stock A is expected to provide a dividend of $10 a share forever. Okay, that's an indicator of a perpetuity right there, which sells and is solved just like a preferred share of stock. So with that said, okay, so back to problem 18, the dividend discount model. So again, one of the observations, we've got stock A, B, and C. B is expected to pay a dividend of $5 next year. Thereafter, dividend growth is expected to be a constant 4% forever. Okay, so here, stock B, we've got we're basically going to have to use a model that allows for constant dividend growth. Okay, the first one will be a perpetuity. This is also a perpetuity, but this is a growing perpetuity. This one is dividends forever, so to speak, constant dividends forever. This one is constant growth of dividends forever. Okay, so in terms of dividend payments. And stock C is more like a 2-stage dividend growth model. Okay, stock C is expected to pay a dividend of $5 next year. Thereafter, dividend growth is expected to be about 20% a year for 5 years. Okay, and this can get a little confusing. Actually, this can get really confusing if you're not used to it. And that 5 years, they're talking about years 2 through 6 and 0 thereafter. It really pays to do a timeline on that one. And then just one quick observation that I think we all can make is the market capitalization rate for each stock is 10%, right? And this is the rate we're using to discount with and to get the value of the stock. So if the market value, the market cap rate for each stock is 10%, which stock out of A, B, and C is the most valuable? Then you turn around and use a different rate of 7%. Well, obviously, if you use 10%, it's going to discount, as you know, the relationship with the discount rate and present value. You're going to have smaller numbers with a 10% rate than the 7% rate. Okay, so that's one relationship that we can draw right away. Okay, apart from that, let me show you what I did. And, the solutions are again, solutions are one thing. And they're, in this book, unfortunately, they're not always correct. But with that said, let's see if I can find number 18. It might be a little confusing without some sort of explanation, right? At least for me it would. So that's why I took time to go through it. Okay, so let's look at this. I've got number 18. And keep this nice and short. And I will annotate the video for you guys, so you guys know where to break off when I'm reviewing, when I'm going through problems, etc. Number 18. Okay, so what I did was I said, okay, here's the cap rate, market cap rate of 10% or discount rate versus 7%, okay, which stock's most valuable. The very first one I did, we really don't need a calculator for this except to use it in the most basic fashion, is P0 representing the present value of the stock, okay, and stock A. And what I did was I used the, just like in chapter 2 with the perpetuities, okay, I used the next period's dividend, okay, over R. This is just like how we value preferred stock. Preferred stock is actually acts almost more like debt securities than it does stock, okay? But it is what it is, okay? So if we use D1 as $10, okay, we use R as 10%. So with 10%, I get $100 per share, right? So let me see here. Let's do that. And that would be $10 divided by 0.10. And that gives us $100, okay, per share. All right, would be the implicit valuation, okay, of the stock. Supposedly in equilibrium, right? And again, this is a perpetuity of constant dividends of the same dividend, okay, of $10 dividends going out to infinity. And you notice I put constant dividend in quotes. All right. And if you want to see where we get the dividend from next period, perpetuity chapter 2, page 27. Okay, can you see that? Yes, you can. Okay, as we move up here, I need to draw a little line so I can see where we're at. Let me put this little marker right here so I know more or less where it's centered, where it's not. Right there. Oops. Let's go move on. How about like this? It'll fall. Okay. So with that said, ladies and gentlemen, okay, let's see here. Okay. So the second one, all right, we have the Gordon growth model. And again, this is a constant growth perpetuity, just like back in chapter 2. If we look back here, we can actually see that back in chapter 2, chapter 3, chapter 2, there is a table, page 27, by the way. We've got delayed perpetuity on page 28. This one right here, okay, that is, oh my gosh, that is basically like, so much like how, that is how they value preferred stock, okay? But just so you get a heads up, this C is really, okay, what you would want to say the next period's cash payment. So in this case, as we go through this, I'm looking for, there was some mention of it. Anyway, back to chapter 4, okay, and we are on 18. We're solving for B, okay, and then I'll be able to get into horizon value using the two-stage dividend discount model or discounted cash flow model. And it's not really dividends are cash flows, so you could say it, yes. It is a discounted cash flow model. Okay, so with that said, ladies and gentlemen, and again, I'm still using a 10%. Basically what I do is I do them side by side here instead of separating the whole thing. So D1, looking back at number 18, stock B is expected to pay a dividend of $5 next year. Thereafter, dividend growth is expected to be 4% a year forever. Bing! Okay, that right there is a sure sign that it is a perpetuity. Okay, I know what I wanted to show you. It's table 2.2. Okay, definitely know that table. It's very helpful to look back at it. All right, which is this one right here. Okay, and you can see where you've got the basically the discount factor for the growing perpetuity, which is here, and then you just put the cash flow up top. All right. Okay, and then regular perpetuity would be like this one right here. Okay. Okay, so back to B, stock B. We've got growth of 4%. We have a market cap rate of 10% versus a market cap rate of 7%, which is going to be bigger, the 7%, because the smaller discount rate you have, or market cap rate, the higher the amount you're going to end up with for your present value. So you'll see that the 7% actually came out to $166.67 per share. Okay, can you see that? Good. Okay, thank you. And hey, could you give me some soup, please? Thank you so much. Appreciate that. I'm teasing. By the way, on stock B, under the 10% assumption for the market cap rate, you can say that the model or the stock was capitalized at a value of, okay, $83.33 per share using the 10% market cap rate, okay? So that's what I ended up with. And the only reason I'm not working the calculator is, and of course we can do that. So in this case, we've got, I'll use this one right here just to verify. And because I've done these already, we've got $5. I'm not sure you can see that. We've got $5, okay? And I'll do the 10. So divided by 0.10 minus 4, that's 6%, divided by 0.06 equals $83.33. Okay, so that's where we get that, and I rounded. Okay, next one. In this case, it would be very helpful to draw out a timeline. I actually drew a timeline here for stock A, okay, our perpetual movement right here, which is a constant dividend going out over time up to infinity. All right. This one again, just like preferred share. Stock B would look something like this. We have $5. Okay. You have a dividend growth rate. Okay. Don't forget that the growth rate is actually solved also by, if you're given the return on equity, which we aren't here, but I'm just mentioning this so you know it. Return on equity, okay? And let me see here. So return on equity times the plowback rate, okay? Plowback or retention rate, all right? And remember, the retention rate or plowback rate plus the dividend payout rate should equal 100%, okay? Which is going to give you the total amount that you have to work with. And that, ladies and gentlemen, is the retained earnings. Okay? So, actually, that's not the official retained earnings. I shouldn't say that. The earnings. All right? So, once you plow it back, then it becomes retained. All right. So, with that said, if our growth rate is 4%, you can calculate let me make sure you can see that. If our growth rate is 4%, excuse the lighting, the $5 is going to grow over year one because we begin with year one, dividend one. And then we're growing by 4%, okay? And then, of course, you're going to get in the third year, you're going to have 5 times 1.04 to the second. and the fourth year would be 5 times 1.04 to the third, etc. All right. And eventually you will have a horizon value. In fact, you could make a horizon value on that one. But there's no need to do it because you can actually solve that one with the Gordon growth model right here. Okay. Now, on our stock C, you're going to need that. Okay, so let me turn that over here. Stock C, ladies and gentlemen. Forgive the chicken scratch as I was writing that out. Okay, so here, let me take 1 second. I want to take a look. Okay, so we're back here on, let's see, part C. All right, part C. So let's go to that, chapter 4, part C, and we are at, and number 26 is just a free cash flow model for valuing business that allows us to use the horizon value as well. And we're going to talk about horizon value right now. I think it's a good one to go over. So let's look at this problem. This is part C of number 18. Stock C is expected to, and let me zoom out a little bit, or zoom in actually, right there. Okay. Stock C is expected to pay a dividend of $5 next year. Thereafter, the dividend growth is expected to be 20% a year for 5 years, years 2 through 6, and 0 thereafter. So that's really a two-stage discounted cash flow model, okay, or dividend discount model. Again, we're using two different market cap rates, 10%, capitalization rates, 10% and 7%. Okay, 7% is going to give us larger numbers for the present value or the valuation of the stock. So what I did was, since we are given the initial dividend of year 1, okay, we do have to contend with two parts here. First of all, let me get rid of the book, okay. And this is also mentioned on, just so you got a heads up here. This one comes from, basically, I believe it's page 89, okay? All right, so forget about this stuff here, okay? The only thing that we really should look at is, as in the solutions, I just kind of wanted to lay this out for you. So when does the stock starts with dividend 1, correct? Okay. So we're given, again, let me turn back here. It's by $5. A dividend next year for $5. Okay. So that's going to be right here on our timeline. Can you guys see that? Yes. Okay. And then for basically from years 2 through 6, or years 1, 2, but it starts to actually, you see the first sign of growth here. You start to have a growth of 20%, okay? So years 2 through 6, all right, is growing, all right? So you could actually redraw this, years 2 through 6, growth of 20%, in the dividend of $5, okay? So the way I like to set this up is to say, okay, when does it start to level out and growth turn to 0? In that case, it takes place at point or year 6, okay? So then, basically what we're going to do is take the horizon value, okay, and we're going to discount all future dividends at that constant rate of 0%, okay? It could be 5% for all we care, but it is 0. And we're going to discount all those dividends back, okay, just like we would in the Gordon growth model, which is basically, we're going to take dividend 7, okay, which is basically this right here. Can you see that? Yeah. So we're going to take you could say that this is dividend in year 7, okay, is equal to dividend 1 times 1 plus G1 to the 5th, okay, times 1 plus G2, where G1 represents a growth rate of 20%, right? And then you get to the point where it levels out and you get a new one, a new growth rate of 0%. So that would be G2, okay? And you divide that. So again, this is the next period's dividend over R minus G. And that, in this case, I'll start with 10%, and then we'll change it to 7% later on. And this is 10% minus, and the growth rate in this case would be 0 at our horizon value, okay? So it is kind of confusing when they use 0. Normally there is something there. You want to make sure that R is bigger than G when you're doing this. And this will give you the value representing all future expected dividends at that constant growth rate, using basically the Gordon growth model at this point. So you bring them all in back to this point, and then you discount it back in to 0.0, okay, along with the rest of the regular dividends, okay? And so that's really how you do these multi-stage dividend discount models, okay? So with that said, our model, and you can see it on page 69, similar on page 95, with the free cash flows, just like the free cash flow. You're going to have right over here, basically what I like to do and how I like to work it is I like to set it up like this. I will actually make the formula and spell it out using R as 10% or R as 7% for stock C. And this is part C. So we've got our formula right here, dividend 1, 2, 3, 4, 5, right? And this will all of a sudden become, we'll have a dividend 6, which is this D1 times 1 plus G1 to the 5th, over, so remember, when we value stocks or a stream of dividends, right, and the horizon value, okay, we're going to value them by taking their present value and then summing them all up. So that's exactly what we're doing right here. So you should end up with, in the end, this is representative of DH over 1 plus R to the H, right? If you've seen this in the PowerPoint slides, PH, which is his horizon value, representative of all those future dividends paying out at a constant rate in the future. And this is at some point in the future. Again, this is actually at year 6 where we're going to start discounting it. And the normal rate would be, or set up, just so you can know where this model came from, 1 plus R to the H, okay? And in this case, and looking back, what am I saying? This is, this would be 1 plus R to the T. This would be T, okay? That would be H. All right, so in that case, when we're looking at this, this is ever so similar to the normal basic dividend discount model, right? So N equals 1 to H, all right? So with that said, or T equals 1, excuse me. All right, so let's flip it over, and I'm going to show you a calculator trick. So we flip it over to, where is that? Where'd it go? Okay, where'd it go? Hold on one second. There it is. Okay, so here's how I do it. And this would be for the 10%. All right. And I first solve for the horizon value. Okay, right there. And you can see where I've worked it out $5. Okay, this would be dividend 7 in year 7, brought back to point or year 6. Okay, and then once we get it using that Gordon growth model, okay, where it's R minus G, and G is just the G2. Okay, so you've got basically the dividend 1 times 1 plus G1 to the 5th times 1 plus G2. Okay, and in this case, it's going to work out to be 5 times 1.20 to the 5th times 1 plus 0 over a R minus G, which is 0.10 minus 0. Okay, so it's a lot of work, right? But the first thing I do is I solve for the horizon value. Then I'm going to solve for the regular dividends that pay out across the years here. And when I do that, and I usually kind of set it up like this, so I can spread them out, get them set up. Because the reason is I can actually pop this into our formula that we made, okay? I can combine the last 2 years, since they're both discounted at basically year 6, right? Year 6. So I can get this, and when I did that for the horizon value, I ended up with a value using the 10% discount rate or market cap rate of 124.41600. Okay, and in this case, I'm going to use the dividends. I'm going to set those up. All right, and my last dividend 7 would of course be what I got in the horizon value on the top in the numerator. And so that would give me a dividend times 1, okay, of dividend 7 would be 12.44. Now that's I'm sorry, that's the wrong number. That's a different number. So in this case, no, that's right. So it is 12.44, and then I divide it by 0.10. So anyway, for the using the 10%, I get the 124.42, or this large number right there. Okay, can you guys see that? Okay, and then when I put it into the formula, again, I'm going to combine the $12.44, which is representative of the dividend at where? Right here, right? Okay. Year 6, which is, again, 12.44160. Okay. But I also have my horizon value of the stock, PH. Okay. And I have to discount that too. So why not combine them both, right? So if we do that, we get $136.86, combining both. And I'm going to discount that and bring it back into times 0, just along with the rest of the dividends. Okay? So that would give me 136.86 over 1.10 to the 6th. If I was using the 7% discount rate, it would be 0.07. 1.07 to the 6th, okay? So a real trick here, instead of having to go through all that work, it is nice to know what this combined value is when we're discounting at basically at year 6, okay? We can combine those values. And so this would, again, be stock C. What I do, and let me show you this trick here real quick, and then I'm pretty much done. I will just fly through part C. It's actually pretends to be a earnings per share problem, and all we are is solving for, I believe, the plowback or payout and the initial EPS 0 and dividend 0, and then we get the rest of the earnings and the dividends, and then we apply the dividends into a very similar model that we're doing right here. Okay, and it's also a two-stage model, I believe. So with that said, what I would do is enter this, and I'm going to do it for, I'll show you what I got for the 7%. 7%, I expected a larger number. I did get it. I got, for my value of stock C, I got 156.50. Okay, and rounded it was actually 156 and 50092, rounded to 156.50. Okay, and that's at the using the 7% discount rate. Using the 10% discount rate, or the market cap rate, I got $104.51. In actuality, I got 104.50.769. Okay, so I expected that with the 10%, it was going to discount more, so with that, as the discount rate increases, the present value decreases, and I ended up with a per share price for stock C of $104.51. Okay, for the 10%. All right, so once again, before I leave this, I want to show you the little trick here that I do. And I actually happen to have entered them already, but let me clear it out and start over. So I'm going to do, what I'm going to do is basically enter each one of these, okay, right here, and I can actually use this as I set it up for the value of stock C, present value of stock C. So I've got, the thing I'm going to be focused on are the dividends first, okay? And actually, even before that, I focused on the horizon value, solving that. And then it's up to you whether you want to keep them separate or combine them. I find it easier to combine them and then throw everything into the calculator, okay? And this is what I want to see on the test, please. At least if you use the calculator, okay? Because you need to be able to get it to this point, draw the timeline first, get it to this point, then put it in the calculator. You don't have to do everything manual and do each one on a subcalculation. So how can we solve for this? We can solve using net present value. We just don't have an upfront cost as required for net present value. And remember that anything above 0 on net present value is an investment worth taking, right? With no other strings attached per se. Okay, I'm going to stop right there for a second.